Okay, let's dive right in. Some pretty big economic news just dropped. The Indian rupee hit a record low, 88.21 per US dollar. That breaks the previous low of what, 87.80 from earlier this month? Definitely a hot topic if you're studying current affairs or prepping for exams.
Absolutely. And it's not just about the number itself, right? What's really interesting and what we want to explore is why. Understanding the forces behind it, the connections, that's the goal today, breaking down the causes, the impact, and what might happen next.
Exactly. Our mission is to give you that comprehensive exam-ready overview, concise but thorough. So the big question first, what exactly pushed the rupee down so sharply? Was it mainly stuff happening outside India or more domestic issues?
It's definitely a mix. You really can't look at them in isolation. Externally, a big immediate factor was the U.S. imposing that pretty hefty 50% tariff on certain Indian goods. Now, overall exports to the U.S. are maybe 2% of India's GDP, but for sectors like textiles, gems, jewelry, leather, yeah, for them it's a serious hit.
Okay, so specific sector impact from the tariffs. What else externally?
Well, the other major thing is just the strength of the U.S. dollar globally. The dollar index, the DXY, climbed up to 98.
Yeah.
And just as a quick reminder, the DXY measures the dollar against like 6 other major currencies, euro, yen, pound, and so on.
Hmm.
When the DXY goes up, the dollar is stronger, which tends to weaken other currencies.
Right, a rising tide lifts the dollar but can swamp other boats.
Exactly. And you see that reflected elsewhere in Asia, too. It wasn't just the rupee. The Indonesian rupee or the Taiwan dollar, they were also weakening.
Okay, so global dollar strength is a key piece of the context. But you mentioned domestic factors playing a role too. What was happening inside India that added to the pressure?
Yeah, domestically, a really significant point was the outflow from equities. We saw foreign investors pull out over $1 billion from Indian stocks. And that happened in just 2 trading sessions. That's quite a rapid exit.
$1 billion in 2 days. Wow, okay.
Yeah. And on top of that, you have the usual pressures like import demands. Higher demand for oil, especially towards the end of the month, means more dollars are needed to pay for those imports. So more dollars leaving the country puts further downward pressure on the rupee.
Got it. So external pressures meet domestic outflows and import needs. How did the rupee actually sort of stack up against other currencies during this time? Was it the worst hit?
Well, looking over the past month, it was certainly among the weaker performers. The rupee depreciated by about 0.7%. Now, the Taiwan dollar actually fell more sharply, about 2.3%. The Indonesian rupiah was slightly less weak, around minus 0.3%. But compare that to currencies that actually gained against the dollar,
Like which ones?
like the euro, which was up 2.3%, and the Japanese yen up 2.6%. Even the Brazilian real gained 3.4%. So,
Yeah.
yeah, quite a divergence globally. The rupee was definitely on the losing end of that trend recently.
That comparison really highlights the pressure. So let's talk implications. What does this weaker rupee actually mean for the Indian economy day to day and maybe longer term?
Okay, so implications. Trade is a big one, and it's a bit complex. On one hand, those U.S. tariffs plus the weak rupee make it tougher for export sectors like textiles and leather. That's the obvious negative. But there's a potential upside, maybe less obvious.
Oh, what's that?
Well, a weaker rupee makes Indian goods cheaper in dollar terms. So, paradoxically, it could make Indian exports more competitive against, say, Chinese goods in the U.S. market. It might partially offset the tariff impact strategically, a bit of a silver lining, perhaps.
Interesting angle. Okay, what about inflation? That's usually a concern with a weak currency.
Absolutely. Imports become more expensive. And India imports a lot of essential things, especially crude oil. So higher import costs mean higher imported inflation, which ultimately hits consumers' wallets.
Right. And the external position, India has pretty large forex reserves, doesn't it?
It does. Around $691 billion, which covers about 11 months of imports. That's a solid cushion. But if these outflows, like the equity ones we mentioned, continue persistently, that cushion will definitely be tested. It erodes resilience over time.
Makes sense. And you mentioned the bond market reacting.
Yes, significantly. Government bond yields jumped up.
Yeah.
The benchmark 10-year GSEC yield hit 6.57%, even touched 6.60% intraday. That signals market concern about fiscal pressure and potentially higher government borrowing costs down the line.
Okay, quite a few challenges there. Given all this, what's the way forward? What can be done?
Well, you kind of have to think about it in different time frames. Short term, the immediate need is often for the RBI, the central bank, to intervene. Manage the volatility, prevent panic selling of the rupee. Hedging tools for businesses also help buffer the shock.
Okay, stabilize things first and medium term.
Medium term, The focus really needs to be on boosting export competitiveness, especially in those sectors where India competes head-to-head with China. And also, maintaining fiscal discipline is key to keep those bond yields in check.
And looking further out long term.
Long term, it's about structural shifts, reducing dependency on just one or two major markets like the US and EU. So diversifying trade partners is important. And continuing the push for domestic manufacturing under initiatives like Atmanirbhar Bharat, self-reliant India, the idea is to reduce reliance on imports overall.
Right, building more internal resilience. So, wrapping this up, what's the key takeaway you want people to remember from this rupee situation?
I think the main thing is to see that this pressure on the rupee isn't just one thing. It's this really complex mix of global events and domestic economic realities, always shifting. And understanding that policy responses, whether it's the RBI stepping in short-term or long-term diversification strategies, are absolutely crucial for stability. It's less about the specific number, 88.21, and more about the underlying dynamics and the strategic responses.
Well put. It's about the strategy behind managing these pressures. So, a final thought for you to ponder as you continue learning. How might future global shifts, maybe another surge in the dollar or changing trade patterns, continue to test emerging market currencies like the rupee? And what are the key indicators beyond just the exchange rate that you'll be watching? That's it for this deep dive. Stay informed, stay curious,